Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fit Hon Teng Limited annual report. Fit Hon Teng Limited offers a diverse range of products and services across various industries. At the core of its operations are the manufacture and sale of mobile and wireless devices and connectors. The company operates in two main segments: intermediate products and consumer products. Under these segments, Fit Hon Teng provides an array of products including RF antenna cable and module assemblies, coaxial cables, light source products, backplane connectors, sockets, terminal blocks, wired headsets, speaker systems, and power accessories. Additionally, the company engages in research and development, manufacturing, and marketing of electronic and optoelectronic connectors, antennas, acoustic components, and cables and modules. The company also offers interconnect solutions, consumer electronics, connectivity solutions, warehousing, distribution, and sale activities. Furthermore, Fit Hon Teng is involved in technology consulting, the design and development of automobile and household appliance components, provision of after-sales services, and manufacture and supply of electronic and electrical components, auxiliary equipment, and motor vehicle parts. In terms of branding, the company offers its products under two well-known brands, Belkin and Volterra. With a history dating back to 1981, Fit Hon Teng Limited has established itself as a leading player in the industry, with its headquarters located in New Taipei City, Taiwan. As a subsidiary of Foxconn, Far East, Limited, the company continues to expand its reach and offerings in the market. Fit Hon Teng's stock price has skyrocketed by over 95.7% in the past year due to a series of positive news events and strategic developments. One key event was the debut of its 448G CHIP-LINK solution at DesignCon 2026, which led to a more than 10% surge in the stock price. The company's strong half-year sales performance also contributed significantly to its growth, with a remarkable 113% stock price increase in the quarter leading up to September 11, 2025. Additionally, Fit Hon Teng's expansion into the new energy sector through strategic joint ventures and the launch of new charging solutions resulted in a substantial year-to-date growth. The company's positive financial results for 2025, including a 12.4% increase in revenue to $5 billion, further boosted investor confidence. Consistent bullish trading and market sentiment also played a significant role, with several daily gains attributed to bullish block trades and a positive long-term outlook. Furthermore, Fit Hon Teng's strategic agreements and showcases, such as its renewed framework agreements with the Hun Hai Group and its capabilities demonstrated at Hun Hai Tech Day, have solidified its position in the market. Overall, these events have positioned the company for substantial growth and bolstered investor confidence, leading to a significant surge in its stock price. Fit Hon Teng Limited market capitalization of $39 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Fit Hon Teng Limited holds a significant advantage in their industry. Fit Hon Teng Limited trades at a higher price-to-earnings ratio of 32 times and a higher price-to-book ratio of 1.85 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key trends and changes in various product lines and end markets. On the growth side, the company has experienced significant increases in revenue due to several factors. The cloud product line has seen a substantial 38% increase, driven by growing demand for server solutions fueled by artificial intelligence, AI, adoption. Additionally, the auto mobility product line has grown significantly, with a 94% increase attributed to the full-year consolidation of German Autocable Group. Other contributors to revenue growth include intermediate products, which saw a 13.4% increase, and cloud end markets, which experienced a 37.6% surge. In contrast, there are also areas where revenue has declined. The smartphones product line has seen a 12% decrease, while the system products end market has dropped by 4.3%. This decline is attributed to upstream supply chain interruptions and reduced shipments of wireless charging products. Furthermore, consumer interconnects revenue has decreased slightly due to a reduction in demand from one of its key customers. Overall, these trends highlight the importance of diversifying product lines and end markets to mitigate risks and capitalize on growth opportunities. The net income of the company experienced a mixed trend over the period under review. Initially, it decreased by 12.2%, indicating a decline in profitability. However, this downward trend was reversed as the net income increased by 1.9% to $157 million. In terms of profit margins, the company witnessed a decline across various categories. The gross profit margin dropped from 19.7% to 18.9%, while the operating profit margin decreased from 7.3% to 5.8%. Similarly, the overall profit margin declined from 3.5% to 3.1%. These decreases in profit margins suggest that the company's ability to maintain profitability was compromised during this period. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the net cash generated from operating activities is $267 million. This amount is more than sufficient to cover the company's capital expenditures, demonstrating a healthy level of operating efficiency. Moreover, the explicit statement, operating cash flow, yes, further confirms that the company is indeed generating positive operating cash flow. This suggests that the business is capable of producing enough cash from its daily operations to meet its financial obligations and invest in growth initiatives without relying on external financing sources. The company's debt level and interest expenses have undergone significant changes. An examination of the data reveals that the total debt level has increased from $2,987,095 to $3,244,045, a rise of over $257 million. Furthermore, the total liabilities have also seen an increase of 15.9% from $2,987,095 to $3,470,183. In terms of interest expenses, there is a notable increase from $114,219 in 2024 to $123,419 in 2025, representing a rise of $9,200. Additionally, the gearing ratio has increased, suggesting that the company's debt level may be contributing to higher interest expenses. Overall, these changes indicate a significant shift in the company's financial position, with both its debt level and interest expenses experiencing notable increases. The performance of various segments and regions within the company has shown mixed results over the past year. On a positive note, intermediate products have seen significant growth, with revenue increasing by 14.6% from $3,765,827 in 2024 to $4,339,713 in 2025. This upward trend is also reflected in the overall segments, which reported higher net gains in 2024, $129,668, compared to 2025, $40,639. However, not all segments have fared as well. Consumer products have experienced a decline in revenue, with a decrease of -2.9% from $685,667 in 2024 to $663,114 in 2025. Furthermore, the audio business has been described as poor, indicating a significant area for improvement. These underperforming segments will require attention and strategic planning to get back on track and meet the company's overall goals. Management's outlook for the company is optimistic, with expectations of stabilization in overall market demand by 2026. The focus will be on developing innovative interconnect solutions for data centers and automotive industries, where connectors with high compatibility are expected to be popular. The company has adopted a 3+3 strategy, prioritizing three key industries: 5G AIoT, acoustics, and automobility. To improve profitability in consumer interconnects, the company will leverage its German subsidiary's technological strengths in automobility. This strategic approach aims to drive growth and competitiveness. In response to customers' globalization expectations, the company is establishing new production complexes, upgrading existing facilities, and increasing inventory levels due to production line relocation and U.S. tariff policy. A slight pickup in global demand for consumer electronic devices is also expected, indicating a positive trend in the market. The company's dividend policy is a notable aspect of its financial strategy. According to the provided information, one key point stands out: the company has chosen not to pay dividends. This decision suggests that the company is prioritizing other uses for its profits, such as reinvestment in the business or share buybacks. In fact, there is no mention of share buybacks either. The absence of both dividend payments and share repurchases implies a conservative approach to distributing excess capital. This strategy may be driven by various factors, including a focus on long-term growth, debt repayment, or maintaining financial flexibility. Whatever the reason, it is clear that the company has opted for a more restrained approach to returning value to shareholders through dividends or share buybacks. Concerns about the stability of global supply chains have been raised due to potential disruptions. One area of particular concern is the availability of rare earth raw materials, as highlighted on page 19. This scarcity could have significant implications for various industries that rely on these essential components. Furthermore, there are also concerns regarding inventory buildup, which has been noted on page 22. Excessive stockpiling can lead to inefficiencies and wasted resources, ultimately affecting the overall supply chain's performance. That concludes the financial summary for Fit Hon Teng Limited. Feel free to comment below, and I will be happy to answer them when possible.